Good morning. Welcome, everybody. Today we'll walk through the key findings from our mini Case 5 analysis. We'll review major topics like distribution policies, dividend theories, and management actions tied to dividend and repurchase strategies. We'll also explore how different income scenarios affect payouts and discuss the advantages and challenges companies face when using residual dividend policies. Finally, we'll look at how market signals and investor preferences, the clientele effect, shape corporate financial decisions. Let's get started. As we explore the distribution policy overview, let's clarify what we mean by distribution. Distribution primarily occurs through dividends or stock repurchases. Dividends tend to be less flexible as they represent a fixed obligation for companies. On the other hand, stock repurchases offer greater control over timing and amounts, allowing companies to respond quickly to market changes. Interestingly, we are observing a trend where companies increasingly favor stock repurchases over dividends. This change is driven by the need for flexibility in distribution policies. Traditionally, dividends are paid out quarterly or annually, but stock buybacks allow organizations to adjust their distributions based on financial performance and current market conditions. This is a strategic move, especially in an ever-evolving economic landscape. So, as we move forward, keep in mind how these dynamics impact shareholder value and corporate strategy. Now, let's dive into some key dividend theories that shape our understanding of distribution policies. Firstly, we have the dividend irrelevance theory. This theory posits that the way a company distributes its earnings, whether through dividends or stock repurchases, does not alter its overall value. It's an interesting perspective that suggests investors can create their own cash flow by selling shares if they prefer. Next, we examine the bird in the hand theory. According to this theory, many investors value the certainty of dividends over potential future capital gains. This highlights a psychological aspect. People often prefer a known amount today rather than uncertain future returns. And finally, we have the tax effect theory. This theory suggests that capital gains are taxed at a lower rate compared to dividends. Thus, some investors may favor strategies that focus on share repurchases to maximize their after-tax returns. In summary, these theories illustrate the varying perspectives on dividend policies and their implications. As we move forward, keep these theories in mind, as they will inform how management approaches distribution policies. Management must decide whether to pay dividends or repurchase shares based on what's best for the company's strategy and what investors expect. If growth is the priority, keeping profits to reinvest or buying back stock makes sense. If investors want regular income, paying steady dividends might be better. Whatever path is chosen, it needs to be clear, consistent, and aligned with long-term goals. Research shows that there's no universal rule when it comes to dividend policy. The results from empirical studies have been mixed. What works for one company or market may not work for another. A big reason for this is that tax laws and investor preferences differ by region and over time. Because of this, managers can't rely solely on one theory or model. Instead, they need to consider their specific context and make strategic decisions that both signal strength to the market and align with efforts to maximize long-term shareholder value. The key is finding the right balance for the firm's goals, financial position, and the type of investors they want to attract. Now let's explore the concept of dividend signals and how they reflect investor preferences. First, consider the clientele effect. Different groups of investors have distinct preferences. For example, retirees typically favor stable, regular dividends because they rely on this income. On the other hand, growth investors often prefer companies that reinvest profits for capital gains rather than pay dividends. Next, changes in dividend policies can be powerful signals about a firm's financial health. A dividend increase is usually seen as a sign of management's confidence in future earnings. Conversely, a dividend decrease might raise red flags, indicating potential issues with profitability or cash flow. Finally, it's important to remember that firms often attract investors whose preference align with their dividend strategy. This alignment is crucial for maintaining a stable investor base. In summary, understanding the signaling hypothesis and the clientele effect helps clarify why firms adopt specific dividend policies. Let's explore the scenario given to us in this mini case. First, we have a capital budget of $112.5 million with an optimal capital structure that comprises 80% equity and 20% debt. This structure is crucial as it helps us determine the equity financing needed, which amounts to $90 million. Moving to our net income scenario, we project a base case net income of $140 million. After accounting for the necessary equity financing, we calculate the residual earnings available for dividends totaling $50 million. This leads us to the dividend payout ratio, which stands at 35.7%. Ultimately, this results in a dividend per share of 50 cents for our shareholders. These insights not only guide our current decisions, but also align with our strategic objectives moving forward. As we dive into the effect of investment opportunities on the dividend payout ratio, let's first consider the dynamics at play. When there are more investment opportunities, companies often face a higher capital budget. This means they require more equity, which unfortunately leads to less income available for dividends. Consequently, we see a lower dividend payout ratio. On the flip side, if there are fewer investment opportunities, the capital budget shrinks. This results in needing less equity and consequently more income available for dividends, allowing for a higher dividend payout ratio. Remember, under the residual distribution policy, dividends are prioritized only after funding those attractive investment projects. So in essence, the availability of investment properties directly influences how much capital can be returned to shareholders in the form of dividends. So now, let's transition to discussing how to save money on capital resources. As we delve into the advantages and disadvantages of the residual policy, let's start with the key benefits. Funding attractive investments. This policy ensures that we fund all attractive investment opportunities, which is crucial for long-term growth and enhancing shareholder value. Debt to equity ratio preservation. It helps maintain our ideal debt to equity ratio, which is essential for financial stability. However, we must also consider the drawbacks. Unstable dividends. An unstable dividend payout may send negative signals to the market, which can affect investor confidence. Impact on income-dependent investors. This policy may not be as appealing to those who rely on dividends for income, potentially alienating some of our investors. Higher cost of equity. Lastly, there may be a higher cost of equity associated with this approach, as outlined by Miller and Modigliani in 1961. It's about finding the right balance between growth and investor expectations. Understanding the dividend process. The declaration date. The company announces the dividend amount and specifies the payment date. The ex-dividend date. This is the final day to purchase shares in order to qualify for the dividend. The record date. The company's transfer agent determines which shareholders are eligible to receive the dividend. And lastly, the payment date. Dividends are dispersed to those eligible shareholders. This four-step process guarantees clarity, transparency, and fairness in the distribution of dividends to shareholders. So today, let's dive into the stock repurchase process and methods. First, we have the four-step process. Number 1, announce the repurchase plan. This includes details on the number of shares, the price, and the time frame for the buyback. Number 2, choose the method. Companies can opt for an open market repurchase, a tender offer, or direct negotiation with shareholders. Each method has its own strategic implications. Number 3, retire shares or hold as treasury stock. This decision impacts the company's future capital structure and shareholder equity. And number 4, disclose financial reports. Transparency is key in maintaining investor trust and ensuring compliance with regulation. Now, let's clarify the definition and purpose of a stock repurchase. Essentially, it's when a company buys back its own shares. This action is often taken when the stock is undervalued with the intent to boost earnings per share or EPS and signal market confidence. Understanding this process helps us recognize its significance in returning capital to shareholders and enhancing shareholder value. Thank you all for your attention. I hope that you were able to learn a little bit more about capital structure, and I appreciate and welcome any and all feedback. Have a great day.